All right. Hello, everyone. Good morning. Thank you for having us at one of the greatest events in Asia, Token 2049. It has always been my dream to come to a futuristic Singapore. So I'm here today with the wonderful speakers and true experts in the field. So the topic of our panel is DeFi and institutions. You will learn a lot of insights firsthand, so stay tuned. And let's begin with a round of introductions. Maybe we'll start with you, Sergey.
Yeah, hi everyone. My name is Sergey. I'm co-founder of 1inch Network. 1inch Network is kind of a set of protocols with a huge contributor team. Right now, around more than 120 people. To my person, I'm a software engineer for like 17 years, and right now we're very active in 1inch Network. We are building the future of decentralized finances. That's it.
I'm Asib. I'm a managing partner at Dragonfly, which is a global crypto investment firm.
Hello, everyone. My name is Chen. I'm the Chief Operating Officer at BitGo. BitGo is one of the world's oldest and most trusted crypto service providers in existence. We've been around since 2013, so almost 10 years in this space. We do programmatic wallets. We do real qualified custody that's insured by various regulators around the world. And we have a PB prime brokerage on top as well. We serve 4 major segments: institutions like banks and other large investment vehicles trying to come into this space, large platform technology companies that want to add Bitcoin and Ethereum to their network. We serve L1 blockchains, love the foundations out there, and of course governments as well. We work with various government agencies in the United States and various governments around the world unlocking crypto for their citizens.
Morning, my name is Ken Timzit. So I lead Kronos Chain. Kronos is a layer 1 chain, so it's a top 10 chain. And from a technical standpoint, it is the first Ethereum compatible chain built on the Cosmos SDK. From an ecosystem standpoint, it is a chain that has a close partnership with Crypto.com and its 50 million users, and is positioned as the gateway for Crypto.com users to migrate to self-custody, DeFi, and NFTs.
Hi everyone, my name is Brian Gallagher. I'm one of the co-founders of Partisia blockchain. Partisia itself has been around since 2008, building commercial enterprise software, specializing in advanced cryptography solutions. We decided we're going to build a layer 1 in 2018, so we've been developing it for the last 4 years. And we're trying to solve the blockchain trilemma. So for scalability, we have sharding, fully complete sharding. We use MPC technology for more secure interoperability, as well as privacy-preserving smart contracts on-chain. So we're launching probably around Q1 on the exchanges. But our mainnet is currently live, and we're onboarding big projects. We'll announce our huge first big partner tomorrow.
Thank you so much, everyone, for introductions. Some really old products here. So DeFi is relatively new. As we all know, it has been growing at a very rapid pace. And for the last year, we've seen over 1,000% TVL increase. We also saw the arrival of the large players into the industry, and also products that now focus on institutional adoption, such as Aave Arc, Compound Treasury. I also know 1inch has announced the 1inch Pro product. Also recently, Ethereum has transitioned to the proof of stake, shedding environmental critics and opening gates to further scalability. At the same time, our industry has experienced a lot of bankruptcies, multiple hacks, the Tornado Cash saga, and some regulatory developments with the latest action against the DAO. So let's try to break at least some of those things down and start on a lighter note and talk about the merge. What do you think, how the merge and it's impacted the institutional adoption of crypto and DeFi specifically?
I would like maybe to start. So I see the merge as a good step forward to to onboard more institutionals in terms of we are green now. So we have still this old Bitcoin and which consumes a lot of electricity, and it's not healthy for us, for children. And Vitalik and the whole Ethereum team did the right step. It took a long time to do that, but everyone should understand it's very important to do it right, kind of in the right manner and highly secured, that nothing can go wrong here. This is a good step forward. Of course, it needs to be improved regarding the scalability. So we need higher throughput. But we have, of course, layer 2 solutions which can be used right now, and Ethereum will come to the point where we will see a lot of kind of throughput as soon we are ready.
Look, from an R&D perspective, this was one of the most impressive feats of engineering, I think, in the history of crypto. It was really, really hard to pull off. Congratulations to the Ethereum core devs. Congratulations to all the engineering teams across all the service providers in this space. At BitGo, we're the backbone to hundreds upon hundreds of brands, 170 plus exchanges around the world use our tech. We had to have zero downtime going into the merge, right? And it was well done. It's the blueprints for Ethereum and this network upgrade should be looked at very carefully and mimicked for other blockchains that need to do something similar in the future.
Yeah, I agree. The technology is incredible, but it's kind of a huge hit for decentralization, and that's.
I wouldn't agree.
We should debate this.
I mean, it's very easy to single out a few entities on the regulatory side and do something about it and cause a bit of a disruption. I mean, they could just back off the market and leave the node operations, which I guess would be fine, but. Regardless, it's just a bit concerning that it happened so fast, and all of a sudden the network is 3 entities controlling over 50% of the private keys to nodes.
I would like to add. So before the merge, we had like maybe 5 mining pools, and they actually controlled everything. And they started with the math. And offered the opportunity to do the flash loans, flash transactions and sandwich attacks, it's not right now. It's better because like Lido, for example, they don't have more than 30%. They try to stay under 30%, and it's now better than before. If someone is doing like very bad, right now they get slashed. They will lose Ethereum, and before miners would maybe went to another, would maybe go to another mining pool, and that's all. And right now they will get kind of sanctions.
So a better way to say it is maybe it exposes the problems that already existed.
So look, I think we have 99 problems to solve. This was one, right? So proof of work was a problem, was a blocker for adoption from an environment standpoint, and it was also a blocker for adoption in terms of Ethereum doubters saying, hey, those guys will never get their act together. So they've been proven wrong. It's one problem to go. Then when it comes to adoption, we have lots and lots of other problems to solve. Custody, prime brokerage, best execution, liquidity pools, inflow of market makers. And so I think we just need to collectively work on those other problems now, and things will never be perfect. But yeah, it's just great that we solved one problem.
Look, in the eyes of the US SEC, in the eyes of Gary, he has stated on record that proof of stake looks more or closer to an investment contract, therefore more potentially inching towards a would-be security than proof of work. The transition happened, and now we're in this world. Other things that has happened, the more recent enforcement action that the SEC issued against this 2018 ICO, I think on page 69, there's this blurb that basically calls out the SEC, because most of the Ethereum nodes operate in the United States, the U.S. SEC has jurisdiction over the entire Ethereum network. Basically, trading activities, doing anything on Ethereum constitutes doing activities on a U.S. securities exchange. So they're stating these things in these enforcement letters. And the combination of things that has happened, I don't know, it I think puts a bit of a dampening effect on institutions and Ethereum specifically.
Well, I mean, to be clear, that was while Ethereum was a proof of work blockchain. So they're making that argument in the proof of work world. In the proof of stake world, that argument maybe is even more defensible because of the fact that, to your point, the number of blocks are, vast majority of blocks are basically being prepared by
Coinbase.
4 or 5 parties, right? Exactly. Now that being said, I think looking seriously at this thing, like Gensler, I think the Gensler comment was pretty grossly misinterpreted. He was mostly talking about staking services like Coinbase, like staking through Coinbase, right? That does look like a security because you're trusting another party to do staking for you. For the most part, I think it's pretty clear he's not trying to go after Ethereum. And to your point, okay, yeah, Ethereum has some, there's maybe more centralization we might want in the distribution of stake. At the end of the day, institutions do not give a shit about that. That's not what they care about. What they care about is that Bitcoin bad, proof of work is bad, externalities are bad. Now Ethereum is ESG, that's good. Institutions move slowly. Like I know a lot of these people, I talk to a lot of these people regularly. They don't go out and start, just mass buying Ethereum the moment that the merge turns on. But it does mean that next time they want to buy something in crypto, they can buy Ethereum according to their ESG mandates. They can't buy Bitcoin, right? It literally, if you have an ESG mandate, you can't touch a lot of this stuff. So I think that does move the world materially forward. And in the long run, it's going to be good for institutional adoption. But right now, at the present moment, just macro being what it is, a lot of institutions, and just the fact that, the Terra collapse and all the stuff that Three Arrows, it has rubbed institutions the wrong way. And I think we need a little bit of the wounds to heal before we see institutions start to dig in again and start to get more involved.
Institutions also want someone to be able to blame. So you could make a bullish argument that when they see like Coinbase, publicly traded company, operating a majority of the nodes, that may make them feel a bit more secure having like value locked on the chain. So there is that side of the argument as well.
Very good summary. I think we've all had enough of the merge. Thank you. Let's move on. And there was another notable development in the industry, NASDAQ moving in with their offering custody for Bitcoin and Ethereum. What do you make of it? And are there any other positive trends you are seeing on Wall Street that perhaps are signaling that institutions are not afraid of the bear market?
I can start.
Yes. Thanks.
Love
Jen.
NASDAQ. Look, it's good to see like really, really top brands in TradFi moving into the space, supporting this asset class. But when it comes to like how much will NASDAQ actually move the needle in terms of institutional adoption or in terms of overall adoption, look, let's see. When Fidelity entered the space a couple of years back, there were some people out there thinking that, oh wow, Fidelity is here. They're gonna just come in, just clean house, suck all the air out of the room, and really, really move the needle. I'm a Fidelity brokerage user myself. I've been refreshing that homepage for the last, 3-4 years. Where is my Bitcoin? Still not there yet. So let's see what happens. In terms of overall industry, over on this enterprise side of the world, not TradFi, over on the Fortune 500 side of the world, we're seeing interesting things happen, right? Like Disney, Mickey Mouse is in the NFT space. Starbucks has arrived. Nike, oh man, how many Nike fans are out there? Has arrived. The loyalty systems, the engagement platforms, NFTs. This is a new space. This is very, very interesting. They're spending resources, and I'm actually pretty bullish on these Fortune 500 brands, basically pushing crypto to their massive user base. And let's see what happens on that front. I'm very bullish on that side.
So I'm actually going to take the opposite side of this. So
let's go.
I think it's not that I'm bearish about institutions coming in, but is that I think institutions coming into crypto is the symptom, not the cause. By which I mean when crypto starts winning and crypto really starts changing things and kind of entering into the collective psyche, what you always see when you ever see any kind of really big technological shift is you see the old guard, the old institutions being like, oh shit, we need a strategy for this. So it's like when the internet really started taking off, a lot of these older institutions were like, we need an internet strategy. And the internet strategy is we're going to put, JP Morgan is going to put a site on the internet. And if you were so inclined, you might think that like, wow, Time Magazine is going on the internet. Now the internet's a real thing. And the reality was that Time Magazine didn't fucking matter after the internet. The internet changed what mattered because of the shift in the underlying technology. And the same thing feels true to me for crypto. It's not that the NASDAQ or NYSE or whatever embracing crypto is what's going to make crypto successful. It's that that's a sign that crypto has succeeded. But crypto is going to embrace its own logic of this technology. And most likely, most of the time when this kind of thing happens, it's through disruption of the incumbents, not the incumbents taking their businesses and putting them onto the new technology. I suspect that's also what happens here.
Maybe for the benefit of the audience, it's also important to define the institutions. Right? So in our world, you have crypto funds, they are crypto native, and they are institutions and they have institutional needs. However, they are very much part and parcel of how DeFi has been built over the last couple of years. Then you have TradFi, and then you have like consumer goods companies and media companies. I think what we're seeing is that it's really the crypto funds who are leading the way and shaping the ecosystem in terms of their needs for tooling, their needs for reporting. And in the end, what happens is that TradFi companies are looking at how much money those guys are making and simply want to follow because they see the profit pools there. So I think the real, what is really positive for the ecosystem is crypto funds, crypto native funds coming in and having increasingly robust and sophisticated operations. A large part of that is due to all the talent and the brain power that has migrated from hedge funds to crypto funds last year. And those guys with algo trading and risk management practices that come from hedge funds are helping to shape the environment and the tooling, and we're all benefiting from that. So I think those guys are really at the forefront and are the best leading indicators that I can think we can see in terms of institutional adoption.
I would like to add, I agree to Hasib. It's going to be the technology will overtake the current traditional financial instruments. Like in terms of Nasdaq, it's cool that they introduce like custodian service, but they will have more and more like products introducing and into own ecosystem. But I see that maybe there's a room for a decentralized Nasdaq, for example. Yeah, it would maybe make everything more efficient, because right now it's very difficult. For example, to write an aggregator for stock exchanges. Yeah, this is almost not possible, I would say. But if you build on DeFi technology, built on EVM compatible chains or use Ethereum, then you're able to build highly efficient financial products. Yeah, and this is the future from our point of view. Something not efficient can stay for a long time. It will be replaced with more efficient technology, and this is the DeFi and the smart contract ecosystem.
So to underline the kernel of what I'm talking about here, it's like there's a saying, I can't remember who said this, but it's something like, it's very hard to get a business to understand something when their bottom line depends on it not coming true. And I think so much of the foundation of crypto and DeFi is a very different foundational assumption from what you see in most traditional finance. Most traditional finance, the model is that you are default closed, that you are default closed source, you are default closed to integrations. Like if you want to interact with me, you need to get a license. You need to go through this very long-winded process. And if you don't have that, then screw you. And DeFi is the exact opposite. From the very foundation, the assumption behind DeFi is that everything is open. Anyone can integrate with anything. All the code is there for anyone to see. And when you build an ecosystem on those principles, it results in much more creativity, but also a very different approach to monetization, to patents to intellectual property. Like almost everything about DeFi starts from a different base layer of assumptions, which is why when you have something like a traditional financial institution looking at DeFi, they're like, okay, there's some kind of cool things here, but we gotta, we can't actually do it like this because it's gonna mess everything up. And that's why I say that I think in the long run, they're two very incompatible visions of what the future of finance is going to look like. It looks more like open source software development than it looks like traditional closed institutions.
Yeah, they're completely incompatible because the custody will lead to trading, which leads to complex financial products like derivatives, options. And the integrity of Bitcoin with the 21 million coin supply is highly jeopardized when you have derivative and options markets trading on Wall Street, because the paper trading of non-physical Bitcoin will be hyper leveraged, and at any time there could be 100 million, a billion Bitcoins actually being traded, without having to move the real coins. And so that could tame volatility because you would have more efficient markets, like trading much tighter spreads. But the integrity of the whole fixed money supply kind of is highly jeopardized. And to Haseeb's point, DeFi is transparency. Everything's happening on chain. The existing system is doing naked short selling of options on shares that don't exist. And there's really no audits or way to dig into that unless you rely on the regulator, who fails over and over again. So realistically, they need to fix their own problems before they think they can come and fix the DeFi and the different systems we're building that create transparency so that we can have automated systems that anyone can see. It reduces fraud. That's my take. Yeah.
Hold on, I want to.
This is a very...
Yeah, I don't.
Oh, man.
Go on.
Look, for those NASDAQ folks out there, we welcome you into the space. Holy cow. Glad you're here. Let's work together to make this entire ecosystem grow.
They're going to do it regardless. Like, they're going to make their own products. It's not like you can tell them, please don't do it.
Right.
It's just something that needs to be... We need to talk about it more. We need to monitor it. We need to see how it progresses and have a say in the system, because...
Well, I find the perspective you're taking. So if I can summarize, you're basically saying that people basically taking an unbridled approach to financial innovation is bad. They shouldn't do it. They should only trade spot. Is that basically what you're saying?
No, because market efficiency is highly increased with these different products. I'm just saying
Like
the
options are bad.
the off-chain
Derivatives are bad.
I mean, no, but like you look at, for example, the way that like the GameStop situation blew up in the face of the people selling the options, and they were able to just pause and say, "Hey, don't let them buy anymore, because if it goes up another 100%, the whole system falls apart, because they all go bankrupt, and now they can't make good on their other options they've sold for unrelated stocks." And then there's basically one clearinghouse, the DTCC, who's the only one who can actually see, how many shares are owed to the other people. Put it all on the blockchain. Then we're talking, because you can actually see, did they sell shares they borrowed that exist, or did they go beyond the threshold that's allowed? No one can audit that except for one agency, and they don't provide any visibility. So when they tell us, hey, you need to do this or that and be more transparent, we need to, as an industry, in my opinion, take this strong stance that they need to start using the blockchains to create more transparency over their systems that they're running on behalf of us. They're working for us, the regulator. That's their role, is to protect us. So let's, as an industry, push them to use blockchains to create more transparency, because settlement networks, everything we're talking about here, if it's all on chain and transparent, then it's great, because the products do what they're intended to do. But when it's centralized and one agency has oversight, we saw it happen, and like the whole economy almost unwound from GameStop. People think it was just this meme stock and a couple of hedge funds went broke. It almost got way worse than that. That's why they pulled the buy button, because if it would have gone up another 100%, 200%, those $15, $20 billion of exposure would have been 100 billion, 150 billion. And then the options traders who sold those options would be bankrupt. They couldn't make good on other options they sold to other people. And so then that's a whole new rabbit hole of market making and the, that we could go way down. But.
Yeah, I mean, so taking a step back, I think that we all, like looking at DeFi, we know that DeFi requires retail investors on one end of the marketplace and institutional liquidity providers on the other end, right? That's the only way that it works. Your question was like, are we seeing positive signs in terms of institutional adoption? Let's face it, right? Today, institutional volumes are down, trading activity is down, and in a way, it's an opportunity. As many have said before, it's an opportunity for all of us to get our systems right, to build the tools that they need, so that when they come back in conditions that are robust and are going to be positive for the whole ecosystem, as opposed to what happened during the last bull run, where I think a lot of institutions or central, hybrids of CDFI companies had to cut corners just because they had to keep up with the market. So I think right now adoption is down, and that's a good thing, and we're focusing on building.
Thank you, Ken. Let's move on and say, if you had to persuade a major institution to step into crypto, what arguments would you use, and how would that be different from what you'd say a year ago? Maybe we'll start with you again, Ken.
Yeah, sure. So I think first, as an institution, you want to make money. You want a profit pool. And the profit pool comes from having lots of counterparties that are not as sophisticated as you are, i.e. consumers. So the big difference today in crypto is that you have overall 350 million people around the world who own some crypto. And out of them, probably 30 to 50 million who are already practitioners of self-custody and are interacting directly with DeFi protocols. So that's an order of magnitude more than a year or 18 months ago. And if you're an institution, that's a very rich reservoir, profit pool. That's a very rich profit opportunity if you're able to deploy trading algos and arbitrage strategies across markets. So really, that's the fundamental appeal of this market. It's the richness and depth of the retail market that we have today. And that's why at Kronos, we partnered with Crypto.com because we saw this influx of new Web3 users as the next opportunity for our industry.
Look, the core arguments still remain the same for Bitcoin and Ethereum. Bitcoin is the hardest money in existence. Ethereum, with the proof of stake migration, now shares some of the same qualities, and it's programmable, which is very, very interesting and useful. The changes to messaging, look, to quote Buffett, people should be very, very fearful when others are greedy and be greedy when others are fearful, right? If there was a moment in time to do some allocation, to get prepared, to get off of zero as a family office, as an institutional investor, this is that time. Furthermore, in terms of what's happening around the world, for all the US citizens out there, this is an amazing time for the US dollar. Like, depending on which country you go to, everything is 10 to 50% off. Seriously, the US dollar is amazingly strong right now. And if you were to look at the BTC or ETH to a basket of non-US fiat, if you look at that trading pair, the two currencies, our two cryptocurrencies, are doing pretty well. In fact, I think yesterday, if you look at the BTC to British pound trading volume, there was like a 10x increase for whatever reason. So folks around the world are noticing this weirdness that's happening around the world when it comes to foreign fiat, and they're flocking to safety, and the safety is BTC and Ethereum.
I would like to add, I would say to the institutions, remove the inefficiency, this is humans, and use programmable money and interfaces to interact with money, yeah, and financial products.
Any more arguments for institutions?
We do work with NGOs, and so one use case that we have that we're announcing soon is a private smart contract that hosts a stablecoin that is used to deliver economic aid in the form of QR codes. And the argument was really simple. It was, hey, when you give out cash, which is what they do, they go into crisis zones and hand out actual cash. What happens to the cash? And they say about 80% goes unaccounted for. So, 80 cents on the dollar, they can kind of confirm as lost or not going towards the cause. And when you sell them and say, look, put it in a private smart contract so your beneficiary's privacy is still protected. They're not going to be, people can't follow the money around. But you can have auditability over the smart contract and see where all the money goes after you deliver it in QR codes. Maybe you increase efficiency from losing 80 cents on the dollar to like none, because you at least know where it can somewhat track it, and then work with local vendors on the ground to see if like the stores are accepting it or adopting it. So I think it's kind of just looking at the true value proposition of cryptocurrency and applying it to use cases that are broken. So that's also in the last question why I alluded to, I would like to see us as an industry take a stronger reverse approach towards the regulator and say, hey, why don't you work with us to use blockchain technology to increase efficiency in your systems and create more trust and transparency with our community and all of the consumers that you are working to protect. And so that's kind of the baseline way we sell our technology in the blockchain, is just identify where they're not efficient, where they're losing money, and how more transparency and trustful systems can solve it.
At a more tactical level, I also want to point out how much of a game changer the evolution of our industry towards proof of stake has been. All right, so staking and staking as a service is really the ideal way for many TradFi and more conservative institutions to get into DeFi, not only because the underlying mechanics are easy to understand, but also because nowadays with Figment, with Blockdaemon, with others, there are true enterprise-grade providers of staking as a service products who are able to deal with the needs and requirements of large companies. And so, yeah, as you know, at a very tactical level, I think that the fact that almost every blockchain now is a proof of stake, that is going to help tremendously with institutional adoption, and is a great way to get into it.
Thank you, Ken. Pretty solid arguments, right? So if there are no more, let's touch upon the traps. Do you believe the Celsius and Voyager bankruptcies strengthen the case for DeFi? What is your opinion of it? And maybe Hasib.
Yeah, so it's funny because after the collapse of Celsius, you saw a lot of incredibly bad takes, especially from the media, talking about how, oh, this means that crypto is terrible and this is like an indictment of the whole decentralized enterprise. When, of course, like Celsius, we call Celsius a lender, but it's kind of a euphemism. Like, they're not actually a lender, right? Like, what Celsius was doing was they were taking money from retail and they were going on chain and doing like crazy degen shit that, like, like my cousin does. Like, that's what Celsius was doing. So Celsius was basically an unregulated hedge fund. And this unregulated hedge fund blew up like my cousin did. And so it's like, okay, yeah, of course. Like, yeah, if you do that, things are going to go badly. And whereas almost everything in DeFi, if you look at like Compound and MakerDAO and 1inch and Uniswap and DYDX, all these things worked beautifully. And the reason why they worked beautifully, the reason why there were no bankruptcies or no underwater debts or any of that stuff, was because in these things, there is no human in the loop. There is no human discretion, right? You guys might remember earlier in the year, there was this big fight between FTX and the CFTC. And FTX was arguing, it's like, hey, we have this like automatic liquidation engine that we all use in crypto. It's 24/7, and it automatically deleverages people when they don't have enough margin ratio. And the people on behalf of the traditional exchanges were like, wait, no, you can't do that. It's like, why can't we do that? We can't do that because what if somebody doesn't have time to post collateral and they're going to get liquidated and then markets are going to get hurt? And they're like, guys, that just happened to nickel. If you guys remember, there was this big thing where nickel, there was some guy, there's some like Chinese factory owner who like owned a bunch of nickel. And he was like, guys, I can't post collateral right now. They're like, great, we're just going to turn off the market for 4 days until you figure out how to post margin. And nobody had nickel prices. And so the reality is that, like, yes, sometimes you can use your discretion and maybe you get the right answer saying, oh, let's back off, let's not liquidate this guy. And sometimes you turn off the market for 4 days because you messed up. And the reality is what crypto says, and it's not always the right answer. What crypto says is that we're never going to use human discretion. We're never going to say, you know what, I think this guy will probably pay us back. We're going to say every single time we liquidate you. And so if you don't post margin, you're going to get liquidated, end of story, no conversation. And that decision sometimes means that there's less credit in crypto, sometimes means that it's more constrained than other markets, but it means that it never breaks. Because crypto doesn't have a Fed. We don't have anybody to come in and save us. We don't have a SAM in DeFi, right? Like in the regular world we have SAM, but not in DeFi. And so DeFi has to stand on its own. And that's why I think DeFi has really shown us something over the last 6 months that CeFi wasn't able to show us.
I'll take slightly the other side. Look, BitGo supports both DeFi apps and CeFi apps, so I'm not taking sides. But in terms of the beauty of DeFi, yes, like it removes all humans from the equation. It's math, and there's a beauty to that. However, when it comes back to institutions and institutional adoption, look, the institutions are not used to this concept. The institutions want that extra 30 minutes, right? Can you wait? The institutions want to pick up a phone and call somebody and have somebody answer on the other side. Robert Nestler is not going to answer the compound hotline because there is no compound hotline. But going to CeFi crypto specifically, I think within CeFi crypto, it's still here to stay. Like Coinbase is not going to go anywhere. Genesis is not going to go anywhere. Gemini is not going to go anywhere. I think there's things that we can do, some elements of TradFi that we can bring over to CeFi crypto to help protect customers, to make this thing a little bit more safe. And that's the separation of some of these responsibilities, right? A custodian does its thing, an exchange does its thing. There's clear separation of duties between these two types of companies instead of having all your eggs in one basket within a single CeFi entity that acts like your cousin, doing weird things that people just don't know about.
Yeah, it's an excellent point. So I think in the end, removing human intervention is great, but codes break also sometimes, as we have seen during the last 12 months.
That's true.
So I think really the overriding theme is transparency. So if you're natively DeFi, transparency is mostly available through the code being open source and verifiable by anyone, and the role of whistleblowers and security analysts. However, I think there is still progress to be made in that respect. Not every up-and-coming startup has their smart contracts verified on the Block Explorer. Many of the bridges are still closed source or keep their code very close to the chest because they are afraid that someone is going to replicate their technology. So I think transparency is what we must strive for, and is what is ultimately what guarantees security in the DeFi world. And then in the CeFi world, transparency is achieved through disclosures and relationship with regulators. We know that's coming, and ultimately that's how those organizations are going to be relied upon when we can't check their books.
I would like to add, so the problem for the institutions is most of them can't actually use DeFi. So because I don't know, hacks happening and hackers put liquidity into Uniswap or whatever, they can't exchange the money because there's dirty money. So we need compliant, kind of regulated environment, I call it. Of course, this is kind of a trade-off. Yeah. So if you have a regulation,
permission pools.
I would say permission environment, not just permission
environments.
pools, okay. Because DeFi is not just AMMs like liquidity pools or something. DeFi is aggregators, for example. Yeah, execute highly efficient the trade among a lot of liquidity sources in the markets at the same time, but it's not possible in traditional finance. Yeah, for example, for stock, I already said in the beginning, for a stock trading, so it's not possible to just go through multiple markets, exchange Tesla stock against US dollar, Singapore dollar, euros, and in one single transaction, yeah, highly secured. So we see already good approaches, like Binance, for example, introduced NFTs. So if you pass KYC, so you get NFT, maybe projects can work with that. We, on one end, we see that we need environment, the whole environment, so everyone can deploy in this environment. For example, Curve can come, Uniswap can come, deploy, we will deploy. And we would like to see that everyone, like all the institutions, all the banks who, for example, need to buy Ethereum, they would use such a kind of environment to do it instead of just working with a lot of brokers, trusting someone, having this inefficiency of humans, I would say, and risk also of the humans, because like.
But do you guys really see permission pools taking off? Because I never quite figured out, right? If I'm an institutional trader, I want to trade with retail. I don't want to trade with people who are as sophisticated as I am.
It's a step in the right direction, but the traction is not there.
Yeah, it's there's permissioned environments, but then they also need privacy. So institutions wouldn't really want everyone to know what types of settlements they're making with other institutions. So that's sort of our thesis and where we focus there, but super bullish on permissioned environments, especially when they have privacy. But it's not saying, oh, it's going to happen tomorrow. It's just, that's what it's going to take to get there.
There's a couple of projects, Swarm, for example, from Germany. They are BaFin regulated. So I had to 2 weeks ago talk with them. Very nice to see. They did really great job, really long work what they delivered to be regulated by BaFin. This German regulator is very strict, and actually they have already kind of Uniswap v2 deployment under permission environment. But yeah, this no adoption right now. But I see a good opportunity very soon to have kind of a set of multiple protocols, maybe also farmings. Why not? Yeah, we can also introduce it, and institutions can trade with other institutions. Why not? Because someone like market makers offer to sell Ethereum, and a bank need to buy for own customers, as a gatekeeper, Ethereum for stable token. Why not? It's more efficient than everything else. We have also Oasis Pro in US, so they are also very well regulated and also plan to offer such an environment. So we need just to put everything together from our point of view and push all together forward.
The jurisdiction management is big too. So we built a feature that basically allows smart contract developers to point at certain nodes, because we make each node register jurisdiction, because we kind of foresee that especially institutions, they can't, as you mentioned, Sergey, they can't mix their transactions into an unknown block that may have some illicit funds that flow through the same block. It could cause them a big issue. So I think that's something that we'll see a trend as well, as jurisdiction management of blockchain applications. So it's something to think about when you're building, and also keep an eye out for.
I see we have 10, 9, 8, 7 seconds left, and I'm sure it was a very fruitful discussion. Let's give a warm round of applause to our speakers. And
thank you.